Thanks for joining us today on Market Call. I'm Marella Fernandez. Darren Sissons on the show, partner and portfolio manager at Campbell, Lee & Ross Investment Management. He'll take your questions today on global and technology stocks. Here's how to reach us. 1-855-326-6266. You can send an email question as well, marketcall@bnnbloomberg.ca. Darren, good to see you. Thanks for coming in.
Good to see you again.
We've seen a lot of strength at the start of 2026 in both energy, oil, and tech, of course, really coming back. Is now the time to look at the areas of the market that have been sort of lagging for 2026?
I think that's really the million-dollar question, isn't it? So obviously, when conflict broke out, that trade got expressed in terms of obviously higher energy prices. And remember, of course, at the peak of pessimism, we saw what oil spot at $140 a barrel, which is just not sustainable globally. Obviously, oil is traded down on the prospect of
some conflict resolution, yes.
Peace breaking out. But having said that, commodities also ran on the back of obviously the inflation that comes through from energy. And so, obviously the TSX is up. But the question is, how much retracement are we going to see when peace does break out? We'll obviously see some. Okay. And for some areas, it could be significant. So I wouldn't be suggesting that there's a substantial pivot out of your AI trades, your energy trades, but I think it is time to think about obviously taking profits. We took profits on our energy about a month ago, which was very, very good. We've taken a little bit of profits on some of our AI trades, but I think moving forward, you want to be pushing capital into areas that the market has really ignored. And I think we also have the scepter of midterm elections in November, and that's going to be very significant for the markets as well. So obviously he's enacting supportive policies. We've got Kuzma that's going to be renegotiated.
Yeah, there's so much going on.
Yeah, there's so much going on. So I think the one area that I'm very surprised at really is the strength of the Canadian banks. You've got a poor economy. We're in technical recession, probably going to go into full recession next quarter based on what we're seeing, and yet the banks are moving higher. So higher interest rates are good for the banks until we start to see the credit losses, mortgagee sales. Lower interest rates would be more beneficial for the Canadian economy. But if we have oil at higher prices, very difficult to see rates being cut. So there's a lot of moving parts here.
Okay. You're talking about perhaps, as you say, taking some profit off AI, taking your profit from energy. Where would you look to put that money today? Where are the spots that have been a little softer?
So I think outside of those areas, and I did mention a couple of those areas in the write-up that will accompany the email out tomorrow. Obviously, healthcare looks fairly cheap. Like, good example would be AstraZeneca. It's going to increase revenues by a third between now and 2030, and the stock's up, yes, but not meaningfully so. So you've got areas like that. You've also got areas in consumer staples. Look at luxuries. Luxury's been decimated.
For some time.
Yeah, for some time. And I don't think that trade's going away. But the money is just, what has happened is money has flowed into the sectors that have worked very meaningfully, energy, defence, obviously. And if those stocks sell off, then what you'll see is there will need to be a pathway for that capital to be redeployed into the economy. And that is really going to be the big issue moving forward. Where do funds flow?
Okay, let's take a quick break. We'll line up some phone calls and also some emails to Darren Sissons, Campbell, Lee & Ross Investment Management. Your questions today on global and technology stocks. Back in a moment. Welcome back to Market Call. We're going to start with an email from Marissa. What is your opinion on BlackBerry and its recent breakout? We'll turn that over to Darren, who's with us today. They have had a bit of a turnaround and said they had done or completed a turnaround and feel like they're in the next chapter of what they're doing. Investors seem to like it. They've moved the stock up. What's your theory on BlackBerry and what it has moving down the road?
Yeah, so obviously it's been driven by obviously the security rollout. And obviously, there's obviously significant spike in deployments, and I think that's all positive. But I think the overriding challenge you've got when you've had a fallen champion, and you look back longer periods of time, and you look at what's happened. So we had John Chen in there, and he was going to turn it around, and it's just been one story after another. And so, a lot of people made a ton of money in the 2000 era when it was the phone. They missed that the phone upside. And obviously, the smartphone, they really did miss that. And really what's left is they've gone forward with the security piece. And, now we've got a spike. So from my point of view, we don't really chase turnaround stories. If something is a little dented, perhaps the market has changed a little bit, or the recession or something like that. But to bottom pick something like this after it's had that kind of spike and expect more upside, I think I'm just a little bit worried. So I think I'd quote, was it Cuba Gooding Jr. from Jerry Maguire, show me the money consistently. I think execution here over a couple of years.
Well, you added the line there, show me the money consistently.
Consistently,
yes.
Correct. Yeah.
Okay.
So over a couple of years, we may look at it, but right now, I think it's just way too early.
Okay, that's BlackBerry. Let's go to our first caller, Chris, on the line in Delta, BC. Chris, go ahead.
Oh, good morning, Morella. Thank you, as always, for taking the call. Darren, I'd like to ask you, potentially this is a great example of one of those companies that's sort of been almost left for dead, and that's Disney. The stock has been down for, pushing 4 or 5 years now, but it really hasn't crashed lower, and they're doing quite a big share buyback. There's a lot of pessimism and agitated people with the management and some of the political sort of statements that they've made, and the fact that the stock has sort of consolidated here for so long, and maybe even some potential big spin-offs down the pipe as catalysts in that. I'm wondering if you would see this as a good opportunity for a long-term patient investor. Thank you so much. I'll hang up and listen.
So their parks have been doing really well, but is their streaming doing better? Is that kind of helping them?
I think the better way to look at this story is not necessarily by individual asset. But I think what happened was, I think this company really became the victim of what I would call ESG and this whole sort of new wokeism. And, the creative folks really embraced that, and it really did alienate big portions of the consuming public. And so, for example, people did not like men dressed up in tutus and doing, for example, the Snow White and the Seven Dwarfs with beards and things like that. And I think that alienated people. So, and then obviously there was the fight with the Florida governor and things like that. So, in full disclosure, we owned it for a long period of time and then sold about 170, 180, possibly even higher. But I think the challenge you've got here with Disney is that the franchise is really one of a kind, and so management just keep making mistakes here. So, if you've got longer term horizon, I think it's inexpensive here. I think there is obviously some upside. There's possibility that one of the tech content players could acquire it for the content. The business is good. It just has to find the next CEO with a vision to grow it forward.
So did you sell it a couple of years ago then?
Yeah, a couple of years ago, yeah. So we haven't been in it for the name. And so really around sort of the 100, was it 106, 107, I think it's reasonable value. But it's not one of those stories where I see a catalyst to cause it to climb significantly. But it is one of those stories that when they get the next phase of the growth rate, it is going to move, and it's going to move further north. And if you look at it over a long period of time, it has been a great franchise, but it is definitely a fallen angel.
Let's get you the next phone call from Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Mercado Libre, the South American eBay/Amazon, is still down 30%. Has it just been caught up in the SaaS apocalypse, or is there something fundamentally wrong? Would you pick up something here at $1,700? Thank you.
Thank you for the question. Now, have you invested in this before, Mercado Libre?
No, I've looked at it a few times, and it is always, I've always taken the view that it was actually really expensive. And, we are somewhat value conscious buyers here. At $1,700, it's probably approaching an area where I would be looking a little more closely. The underlying growth of that segment is positive. The demographics of the region are good. So I think this is one to actually do a little bit of work on. In terms of companies that we tend to look at in the region, we do like FEMSA, which is FMX, but we've never had an opportunity to get it. That is one of the businesses they run is the 00X franchises, and they were rolling out like Couche-Tard type stories in South America. So I think we prefer that a little bit better. But Mercado Libre is a good story, and I think that it's worth taking a little bit of a deeper look. But at this point, we're not there.
All right, let's take a quick break. Then we'll line up some more phone calls and some emails for Darren Sissons when we come back. Stay tuned.
Yes.
Welcome back to Market Call. Thanks for joining us. We are going to go to an email from Emily. Can you tell me your thoughts on engineering companies in general going forward? I own WSP Global and Atkins Realis, but with advancements in AI, they're dropping. Is there a future for these companies? Should I sell them now? We talked about software business being at risk. People think engineering businesses, consulting businesses are at risk because AI is going to do that work. Where do you stand on engineering?
I'm not sure I agree with the premise that AI is going to interrupt construction businesses, because the lion's share of the work and the economics are made through some guy out there with a hammer whacking a nail, right? Like, fundamentally, it's an execution business. And yes, the design portion of the the project may be streamlined through AI, but a lot of those projects are one-offs. So it might accelerate the gathering of the data. It might do some things with regards to the design, but the fundamental execution of when you, like, for example, if you look at what Canada's doing here with potentially pipelines, up to the Arctic and various infrastructure projects, that's got to be good for the construction companies. The fact that you can design it faster with AI, okay, that's great, but I don't think it changes the fundamental narrative on companies. The biggest challenge I've got is if you look at what Atkins Realis did. They changed their name from SNC, and that legacy is gone. So you've always got somewhat of a risk that there's a grift element in those stories, and it has the smell, regardless of whether they've done it. That story does come across, and so at these levels, I think they're okay. It's not a sector we would plan because they're more project cycle businesses, but I don't see the AI narrative here at all.
Okay, let's go to Callum on the line then in Thunder Bay, Ontario, with his question today. Callum, go ahead.
Hi there. Sulu investor, I was just looking at what your thoughts were on Amazon over the next 5 years, and if there's any type of the business segment that investors aren't fully valuing yet.
Okay, thank you for the question. Amazon's got a couple sides to the business. Retail seems to be doing a little bit better. What about its tech service?
Yeah, so I think the big challenge is if you show a slightly longer period, what you see is the company was relatively flat for about 5 years. Like, it was plus or minus in a small band. So look at that. It sort of went from 140 through to 40. And if you do that over 4 or 5 years, that's not a huge growth rate for a company of that size with that level of market share in the sort of the cloud computing space. So there are a number of things that are being done, but it's had a recent pop up here. But given the demands in the CapEx spend relating to the build out of AI, I am somewhat troubled by for example, what Google did, having to issue $80 billion worth of debt to fund that program. I think the appetite for AI build out is starting to reach natural thresholds here. And so, management teams of enterprise customers are rightly asking, what's my payback here? Am I getting a payback? And it makes sense for the companies that are deploying the infrastructure, the semiconductor chips. But if ultimately I'm going to pay for it, what's my value proposition? And I think that's going to be something that's going to hang over a number of the big tech names. So at these levels, if you own it, great. I probably wouldn't sell it, but I wouldn't be backing up the truck here.
Yeah, people sort of were thinking along those lines about the spend out last year, started this year, and then those kind of evaporated. Everybody got excited about AI and the build out again and plowed back into some of these stocks. But you think that concern about too much spending is coming back?
Well, I think the big challenge is just really the cadence of growth. Can the current level of growth continue at the current levels? And so, if, for example, we see just a moderation of spending to fall 20%, that will create a significant haircut for valuation multiples. And so you look at companies that have benefited from the cycle, like SanDisk, like that's insane. Like going from $30 to $1,600, like how does that make economic sense? And then people are saying, well, let's buy Sanders. So, when you've got a much larger company like Amazon, like you get rich when you buy, not when you sell, right? So be careful how you deploy new capital into an opportunity.
Let's go to Deborah then. Deborah's on the line in Okanagan Falls, BC. Deborah, go ahead.
Oh, hi. Good morning. My question today is on Palo, I don't know how to say it, Alto Networks. I was eyeballing this stock in the mid 240 range, and I read an article that the company is basically just on the expansion of the growth curve with much more to go, and is very much a leader. I'd like your thoughts, and do you own, and is this an entry point?
Okay, so Palo Alto, do you have the same AI concerns? It's cybersecurity here?
Yeah, so I like the cyber security, but look at that growth since that more recent inflection growth. Like it's just gone hyperbolic. I don't really like that trend. Like I don't want to become the buyer who holds the bag for when everyone else gets out. So there's somewhat of a Ponzi scheme. Now, that said, I do think that there is going to be significant growth in the security markets. There's a number of different vendors. Obviously, Palo Alto is a premier name. So great company. I'd just be looking for a better entry level here. It just screams a little rich, and I just don't like investing in charts that look like that. Like look at the move from April through to now.
Yeah, it's pulled back a little. I guess that's what she's thinking is right now it's a little bit off. Not enough.
Yeah, not enough for me. Yeah, like that's if it was to fall back down towards sort of below 200, then I might look at it from a fundamental point of view. But at the current levels, it's just too elevated, particularly with all we've got going on. 2 wars, oil inflated, inflation, technical recession here in Canada. There's going to be opportunities. Don't rush to be someone else's Ponzi scheme.
All right. Let's take a quick break. We're going to be back with some past picks from Darren when we come back. Stay tuned. Time to go through some past picks from Darren Sissons. These are from August 26th of last year. At the time, he chose Novo Nordisk in New York, so NBO at 55.34 US at the time, 43.81 today, so 21% downside, 17% total return downside. Is this having to do with the patent?
So let me just tell you a little bit of a story. So Novo Nordisk was the most successful investment in the history of our franchise. So we bought it 9 years ago, just before Donald Trump got the keys, and Hillary at that time was going to hammer the medical, the healthcare segment, and obviously the leader in diabetes, and then we had the Ozempic crisis, or rage. And so we cut it 7 times. And then last year, when it became very obvious that Eli Lilly had the #1 franchise, we sold it all. But the biggest issue we've had with Novo Nordisk, and we're completely out, is that it just generated huge capital gains, of magnitude. When you cut something 7 times, look at the chart.
Yeah.
So when we were in there 9 years, the gains were huge.
So did you take the money and put it into something similar in the space?
Yeah, I know we put it into different areas of the economy, different names, as part of our portfolio, so just reweighted. But we cut it 7 times, and we're out now. So
okay.
Yeah, so we don't own it.
Let's get to your next pick from August of last year, Tourmaline Oil, a TOU on the TSX, 57.98 at the time to 65.55, 13% upside, 16% total return. I imagine you stayed in this, or have you trimmed?
Yeah, no, we still own it. And I think one of the big issues is a lot of generalists ran into the energy space. But I think what we found was that natural gas was decoupled from oil in North America. And the reason being that the drill baby drill thematic in the US to offset the supply shortage created a glut of natural gas. And so obviously prices came down. You can see the chart. But the big upside for Tourmaline is obviously good management, good balance sheet, consolidation play, but the ability to export through LNG Canada, through to Europe, through to Asia, to get Asian pricing for natural gas is going to be big.
And we're seeing some of those contracts now get signed. Correct.
And obviously LNG Canada is going to increase the ability with the throughput. So I think 60% of the production is is outside the Alberta discount. So that's going to be positive for the company moving forward. So I would say you'd hold this company here.
That's Tourmaline. Let's get to your last pick from last August, Visa. V on the New York Stock Exchange. We've had a lot of questions about Visa and MasterCard of late. 351.18 US at the time to 322.15 today, so 8% drop return and total return. A lot of investors want to know what someone like you thinks about holding this longer term. They've watched it go up for so many years. They can't believe that it's tracking down or sideways and not really getting to where it was. What's your take on forward movement for Visa? We've
owned this a decade. Okay, so maybe you can see a longer chart.
Sure.
So what I would give you is the sort of the long-term thematic. So I think fundamentally we're not going to see a reduction in the in digital payments. It's not going away. In fact, if anything, I think we're seeing more of that moving forward. So that plays into the company already. The inclusion of Visa Europe was very powerful, enabled the company to mature, to optimize its balance sheet and income statement. And what we saw was the usage of debt, significant increases in dividends over time, plus buybacks of size. And so periodically, whenever the company goes on sale, it's usually a mistake not to buy. So the last time I added some exposure was around 2020, at the bottom of the dip, you can see, and then look what happened. So my advice to viewers would be, when you're looking at a company like a Visa, this is a franchise company, probably best of breed in the space, going to benefit from tokenization, digital, all of the things that everyone knows. When it's on sale, you want to buy it. And then you just sit back and wait. I've personally owned it 17, 18 years.
And have you trimmed along the way?
I've trimmed the cost base 3 times and reinvested that. So it's just been, it's probably my personal single biggest investment, a successful investment.
Let's take a quick break. On that note, we're going to be back with Darren Sissons to take more of your questions. Stay tuned for that. Welcome back. Dean has written in. He says, what are Darren's thoughts on the cross-border purchase for TransAlta today for power plants? It looks like the market does not like it. Is this not a buy for mid to long term to play the power data center future? Let's have a look at the line chart for TransAlta and see where we are today. But what do you think?
So to deal with the last part of the question, in 2000, we had the same trade. .com is going to drive this massive energy demand. And effectively what happened was it died. Same with the .com there. So I think that this whole idea that we're going to see massive demand for energy from data centers assumes that that we're not going to see copper taken out of the data centers, and the demand for energy is not going to be optimized and reduced. You know, things such as the transition to DC, direct current power sources, all of these types of innovations are going to lead to a lower consumption. So I think those who are playing the AI trade through utilities are probably a little bit mistaken. And now in terms of the company, you know, like as I mentioned earlier in the show with regards to Tourmaline, there's a glut of natural gas assets in the US, big production because of obviously the drilling to offset for the oil decline and supply. So buying assets when they're on sale, I like that. I think that's a good thing. So I think they're a good operator. Hopefully that they've bought a good asset. It's a little early to tell. We'll have to wait and see what's happened. But I see this as a positive sign, not a negative. And you know, I think that you should. I think we'll find when we see normalized gas prices, this actually might be a very good asset.
All right, let's move on to the phone lines. We have Jim on the line in Chatham, Ontario, with a question. Jim, go ahead.
Hello. Thanks for taking my call. I was wondering, I was thinking of buying either TELUS or BCE. would you buy either one, and do you own any of it?
Okay, thank you for the question. Of course, BCE, parent company of this channel under the Bell Media banner, both in telecom spaces, both going sort of different ways to raise revenue. And there's concern about the dividend for TELUS, as you know. Where would you go?
So I think that if in the current environment, we've got heavy risk on in terms of very narrow sectors. You've got technical recessions and so forth. I think you have to think about what kind of investor you are. So I think the telcos generally, and I'm talking a global basket. You know, you've got everything like Deutsche Telekom has been fantastic, but everything Verizon, Vodafone, Orange, TELUS. If you're going to have a basket of those, you can use it as a bond proxy. And if you use it as a bond proxy, then you're going to build income coming into your portfolio. That income can then be used as defensively to protect your downside, and then it can also be used to redeploy into growthier names. So it gives you some ballast. So I don't really have a problem with investors looking to do that strategy.
But you wouldn't pick one over the other, for example.
Well, I think BCE had its big step down already. So TELUS looks like it's having that moment now. If they cut the dividend, then I'd probably buy that. But I don't really see too much of a problem for either if you're going to hold them longer term. But I see them as an income story, not necessarily as a
growth story.
As a growth story, yes.
Okay. Let's go to an email then from Mike. Mike says, I have shares in AVGS Broadcom. Please explain. They report a record quarter and the stock drops $70 US a share. So please help me understand that. And we've seen that in tech, right? Where they go gangbusters and they have great reports, and then investors are like, why?
Well, I think the primary reason is guidance. So what happens when they guide down or they guide to lower levels than what the market's expecting, there's a sell-off. But there's also an element of profit taking. When you look at what has happened in the tech space, particularly companies that have benefited from AI, the infrastructure trades, what they've effectively done is they've moved significantly above their long-term sustainable growth rates. So smart money's taking money off the table. And so if you take a little bit of money off the table, you're still riding with the house's money. Like, look at the move up there. So, if you'd owned it a year ago, it was 200, then it went to 400. Is that 420, sorry?
409 today.
So 409. So you're up 100% on the year. So, is 100% year-over-year growth a reasonable expectation for a stock? The long-term S&P 500 return is 7% or something like that? Although it's been skewed a little higher with the recent numbers. But, at these levels, taking a breather, having a pause is fine. But it is a very good company, and I really like the CEO, and I have owned it before. So I wouldn't be buying it here.
Let's go to the next email then. Tom says, my question is for you, Darren Sissons. With your blessing, I bought a Rio many years ago, and I enjoy the dividend. The position has grown to 6.6% of my portfolio. I'm not really looking to sell, but David Burrow suggested BHP as a top pick. Do you think it would be a good idea to continue holding Rio, but any new buys, so add new money to BHP? Yeah,
so, obviously not going to criticize David. I think he's obviously... he's been around a long time. I think he's obviously done a great job from what I can tell. So he may have a reason to own Rio over BHP. We own BHP. It peaked out around $92, $93, and we had a discussion internally.
BHP did?
BHP, okay. Yeah, you can see it. It's come back a little bit. And we had a discussion internally to trim it. But the problem that we had is we trimmed Franco, we trimmed the Shell, Suncor, and we also trimmed Alphabet. So the problem is we have our clients are going to have a capital gains problem this year because they've had such big, huge movements. And so we probably should have trimmed BHP, but there's a limit to how much you can risk manage your portfolio. There's certain limitations. So I like BHP long term. Do I think it's a little elevated from where we're at? Yes, I do. But I probably wouldn't be buying a whole position. I think if I was going to add, I'd buy half position. But it's a great name, and I think it is probably the best of breed. But in terms of Rio, at 6.1% of your, let's call it 7% of your portfolio, maybe take some profit off the table here. That would probably be the wise thing to do. Okay.
Let's take a quick break. Back with Darren Sissons of Campbell, Lee & Ross Investment Management in just a moment. Stay tuned. Welcome back. We have an email from Hal. He says, can I hear your thoughts on Shopify? We'll turn that over to Darren. Shopify gets treated a lot like a software company, right? Pretty volatile and down with the AI concerns. Mm-hmm. Do you like Shopify? Have you ever bought into it?
No.
Why?
To me, it's sort of the small home office portion of the economy. So it's like paychecks versus ADP. So you got the small portion of the economy tends to be more volatile. But one of the fundamental issues that I don't like with this stock is that the founder, through a very small share of the ownership, has like 40% of voting control. I really don't like that. And it's been good when it's been good, and then it's been really bad. So it's down here. Like the smart money was probably bought in 2022 here. But I just have some governance concerns. And it's not that I think the CEO is a bad guy or he's doing things that he shouldn't be doing, but if he really didn't have a different agenda than what shareholders have done, why is he not in the same share class? So to me, it's sort of one of the core credos. I don't like that, and I try to avoid it whenever possible. And I think he has 40% control of the votes, and that doesn't work for me. So it's a pass.
Let's go to the next email then. Paul from Paul says, your guest's take on CNQ. So Canadian Natural Resources, big Canadian company, pretty solid, run up, of course, with what's going on in the Middle East. Are you invested in CNQ?
Yeah, we have a little bit of it, yeah. And we have also trimmed that a little bit as well, sporadically through our system. And so, I would echo the same point. If oil comes back, it's going to retrace quite heavily. So take a little bit of profit here. It's a good company. But what I would love to see, I'd love to see CNQ and Suncor put together. It would make a behemoth
powerhouse
of the size that would be global peers relative to Shell and Exxon and so forth. So, that would be my wish for that company. Good company, but at this point, take a little bit of money off the table.
Where are you landing on oil once this conflict is done, if it gets to the point where it's done? A lot of people think oil is going to remain elevated because it's going to take so long for what happened in the Strait to unwind. What are your thoughts on where oil could land? Yeah,
I think that's a very prudent view. I do think that oil does definitely step back, but if it steps back 10%, and you've also got investors that have leverage on that, for example, some of their hedge funds, and I'm talking some of the trading and commodity houses, that will have a much larger effect. But for example, Qatar is one of the biggest suppliers of natural gas. Their production facilities are apparently going to be offline for 3 years. So I think if you're thinking about oil, then you want to get some exposure to companies that actually benefit from the rebuild, like Linde will do it. Air Liquide would also do the same thing. But I do think oil steps back down. But there's also the threat, obviously, for electrification, and that trend is moving further forward, obviously, in Europe with higher density, in Asia. But I don't think the world's going to get off oil anytime soon. Plastic, just the fertilizers, this petrochems, we still need all that. There's no alternative solution. And I think the ESG overreach has sort of been somewhat dented, and I think that's sort of changing as well.
Okay. Let's go to another email from Gurmeet. My question is, SpaceX is going to be public June 12th or so. So should I buy same day or should I wait? We're getting a lot of these two people are very excited and interested in SpaceX. What do you expect when that IPO happens? Do you ever buy day of IPO?
No.
Okay.
Not generally. But I've got to wonder. Just if you look at if you decompose how the IPO is going to work for a SpaceX, it looks very problematic. And I know some individuals that actually have some exposure directly. And I think the challenge is it's going to be priced to hype. It's going to run up, and I think you're going to find it's probably going to disappoint. And I think you need to ask yourself at this point in the cycle, is SpaceX the AOL Time Warner trade? Mm-hmm. And obviously, for those who don't know that reference, that was a serial disaster. So I do think space is an interesting category, and there are a number of different ways to play it. But I just wouldn't be buying SpaceX here. I think you just got to wait and see how it plays out.
Do you think that other parts of that space trade are going to get lifted by the IPO for SpaceX, and maybe if at this point look to those other areas? of space. MDA is one that comes to mind, of course.
So MDA, obviously there's money coming into the MDA trade for that thematic, and obviously there's also a defence angle as well. But what happens if that goes away? But there are a number of different areas. So, for example, you've got traditional satellites, so that's a category. Then you've got weapons, you've got communication divisions. So there's a number of different ways to play this, and it depends on how you want to do it. But the ultimate question is, how does the business create money, and are those revenues and the economics that come from that sustainable and growing? And you got to wait and see, right?
Okay.
You got to wait and see.
Let's squeeze in another email before the break. Matt says, could you please let me know your thoughts or analysis on Propel Holdings, great company, running strong, but got caught in the sell-off of more questionable companies. So private credit concerns. We'll bring up the chart for Propel. It did sort of tank, I'm going to say, at the end of last year, crawled back a little bit, but kind of sideways.
Yeah, I think it was the go easy noise, right? Yeah. So I'm not a huge fan of the alt lenders. You know, I think periodically we've seen the Canadian investment landscape littered with a few of those blow-ups. Right? Coventry, for example, you've seen this, go easy. I think if you're going to look at specialty, I think exchanges probably look better. One company I was looking at quite closely was Wise, which is the money transfer company that transferred from the UK to the US main listing, but they just ran into a regulatory issue. So I think you got to be really careful in that space, because these are usually generally small companies with the expectation they'll be acquired, and so just put your money in better places, I would think.
Let's take a quick break. We are going to be back with some new picks from Darren when we come back. Join us tomorrow for Market Call with Brian Madden on the show, Chief Investment Officer at First Avenue Investment Counsel. They'll take your questions on North American equities. That is tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to some new top picks from Darren Sissons. We're going to start with Mettler Toledo, MTD, on the New York Stock Exchange. They do a sort of measuring equipment, so science kind of, is this more healthcare oriented or science oriented or both?
Yeah, well, their core expertise is scales, weighing. So everything from a millionth of a gram for the drug discovery unit through to truck scales on the motorway. So everything in between. It doesn't pay a dividend, so it tends to be a little bit more volatile. But they buy back 3% of shares outstanding on an annual basis for 20 years. So the stock has actually got quite expensive. And so when it's on sale, it's actually a name you want to look pretty closely at. So sort of fundamentally, 5% revenue growth, and over sort of 10, 15, 20 years, you've got between 9.9 and 11% net profit growth. So very positive operating leverage. So almost two times what you get at growth, revenue growth.
Is it cyclical? Is it sort of more steady? I'm looking at the
It's
line
more
here.
steady, Eddie.
It is more steady.
So 5% top line on average for 20 years, and 9.9 to 11% for 10, 15, and 20 year net income growth, plus a 3% buyback.
How long have you held it?
Not long enough.
Not long enough. Okay. Let's go to your next pick, which is Couche-Tard, ATD on the TSX, well-known Canadian company that operates at convenience stores, gets some money, I guess, from fuel as well as gas stations. A lot of people have been disappointed because it hasn't sort of come back gangbusters after going to Japan to try and get the 7-Elevens. But do you like it? Have you been picking it up here?
So we've owned it for quite a long time. Okay. So, you know, there's a few things to note. So it's really gone from relatively humble beginnings to they have 17,000 locations, 13,000 obviously gas refueling locations.
And is it mostly, it's Canada, US, anywhere else?
Canada, US, obviously Europe as well. Okay. And so really it is a growth by acquisition tuck-in story, plus a little bit of organic growth. And so 2% share buyback, dividend growth. I think, as you can see from the chart, since 2024, it's kind of been flat here. But if you go back a little bit further, what you see is just a company that has very good execution from management, and I think we'll see more tuck-in acquisitions over time. So it's inexpensively priced and gives you exposure to the inflation that consumers are paying every day, right?
Do you have a concern about consumers having less money to spend these days and perhaps when they go to those convenience stores, not spending much?
Well, I think that 13,000 of those locations are gas related. So the economy is obviously predicated on people moving. So if you take the assumption that it's going to come to an end, and I think maybe you need to be going out and buying bullets and guns, right? Because the economy is very, very poor. But I think longer term, we've weathered the 1970s energy crisis, and if that's the case, then companies like this will perform well.
Any concerns about bigger acquisitions? A lot of people are saying, as you mentioned, they grow by acquiring, but they're so big now. What's left to acquire?
Well, obviously that that becomes a question of geography. They bought 270 sites in the US last year. And of those, they had to sell 35, obviously for antitrust reasons. But they're now the number 2 company in the space in the US. So they might look to Europe, use Asian opportunities.
So you think they'll open up new geographies, maybe?
Well, I think that's one of the ways to grow. But you've also got savings from procurement. There's a number of different ways once you get to a critical mass to drive companies forward.
Okay, let's get to your next pick. Your last one here is JP Morgan. What do you like?
Well, Jamie's running it, and he's done very, very well. So obviously, apart from the fact that it's had a very good dividend growth trajectory after the last 10 years, double digits. You've got a 3% buyback. But the interesting part is the company is effectively the best risk manager in the banking space in the US. And we saw that firsthand during 2008. So they survived well. They were given effectively by the FDIC, which is the US bank regulator. They were given Washington Mutual, commonly known as WAMU. 2023, they got First Republic, again, also for pennies on the dollar. So they just keep getting more and more, getting bigger and bigger. And so they are the de facto lender of last resort in the US, obviously tied to inflation, growth drivers, and demand for credit in the US. So it's a very good company. We've owned it for a while. We're happy.
Are they going to benefit much this year from deregulation in the U.S.? Is that still of interest, considering everything else that's going around?
Yeah, so, I think perhaps what, for viewers, what you're referring to is things such as the watering down of the Basel regulations in terms of Tier 1 capital. So I think after 2008, regulators took the view that more capital is better. It causes banks to become less highly leveraged and less susceptible to Lehman Brothers events. Mm-hmm. And so, look, one of the issues of that thinking is that banks' growth rates have slowed and they became utilities, and the utility aspect then slowed the economy. So, look, if Wall Street is not making, or Toronto is not making significant amounts of money, other parts of the economy are not working. So there is a natural balancing between how much the banks are making and how good the economy is. And you need a smooth mechanism where capital is flowing through the economy. And obviously, JP Morgan is a company that's very good at making the capital move through the economy quite quickly.
With some of the financials, particularly in Canada, we've had some questions about would you step in now because they've run up so much and the valuations have changed and people want to know, should they step in or do you think there could be a pullback?
So I think I have somewhat of a contrarian view on the Canadian banks. So we've got a technical recession, probably going to have a full recession. Higher interest rates, if that happens because of inflation, is going to be bad for the economy. It's going to be bad for banks, and we're going to start to see mortgagee sales and credit losses. The banks did not build provisions. Okay, if we see interest rates cut because the economy is weak, then that might be good for credit. So lower interest rates are bad for banks. So when I look at how much the banks have run in the last 2 years, I'm kind of scratching my head thinking, okay, great, we'll take it as investors, but I don't see the sustainable logic for the trajectory they've got. And remember, in 2008, just look at how much those banks actually declined. They can move down south significantly. So, it's like anything. When you've made really good money, risk management takes some profits off the table. Got it.
All right. Got to leave it there, Darren Sissons. Good to see you. Thanks for coming in.
Good to see you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.